Okay, let's dive into a massive shift happening right beneath our feet. We are witnessing the entire global financial system evolve from clunky legacy banking to lightning-fast blockchain infrastructure. In this explainer, we're going to cut right through the usual crypto hype to examine the actual technological plumbing that's rewiring how money moves around the world.
So, researchers at the University of Chicago recently posed a huge question. Are the traditional banks we use every single day actually becoming obsolete? It sounds like a radical idea, I know. But when you really look at the fundamental architecture of modern finance, the cracks are absolutely starting to show.
To figure that out, here's our roadmap for this explainer. We're going to start with the legacy banking problem, break down Bitcoin, stablecoins, and CBDCs, look at how the infrastructure is being rewired, dive into the digital wallet revolution, and finally ground it all in the reality of risks and regulation.
Starting right off with part 1, the legacy banking problem and the hidden costs of the old system.
To really put this inefficiency into perspective, think about this. Traditional banks are charging a staggering 6 to 7% in fees just for cross-border remittances. That's huge. If you look at a country like India, which receives over $100 billion in remittances a year, that means $6 to $7 billion are literally being extracted by middlemen instead of going to the actual families and local vendors who need it.
You know, legacy banking systems are kind of like rusted plumbing. They're stuck on 9-to-5 trading hours, rely heavily on middleman reconciliation, and use T+2 settlement. That means it takes 2 whole days to clear a simple trade. But blockchain, it offers instant atomic settlement on a completely immutable ledger 24/7. Think about it. When news breaks on a weekend, legacy markets completely freeze you out, forcing you to bear all that liquidity risk. But crypto infrastructure lets you manage that risk instantly.
And hey, it isn't just about speed, right? It's also about stability. Financial analyst Lynn Alden points out something crucial. Banks run on a highly levered fractional reserve model. Basically, for every actual base dollar out there, there are 4 to 6 claims on that exact same dollar created by bank lending. That's your broad money. And that structural reliance on fractional reserves is exactly why traditional banking is so vulnerable to cascading panics and bank runs.
All right, let's move on to Section 2. Bitcoin, stablecoins, and CBDCs, basically the new asset classes.
We really need to get our definitions straight here, because these are definitely not the same thing. Bitcoin is a decentralized asset with a strict fixed supply of 21 million, which is why it's often called digital gold. Stablecoins, though, are bridge assets. They're typically pegged one-to-one to fiat currencies, like the US dollar. And then you have CBDCs, or central bank digital currencies, which are purely digital money issued directly as a liability by a government central bank.
So, breaking this down, you can see how each asset has a totally different job. Bitcoin, totally decentralized but highly volatile. Stablecoins, they give you that low volatility you need for everyday payments and moving money across borders. And CBDCs, they offer fiat stability but keep that centralized government control. Honestly, seeing them laid out like this really shows why we should view crypto as a massive upgrade to broad financial infrastructure rather than just one giant speculative casino.
Now, this brings us to a super fascinating nuance that completely challenges a popular narrative you hear all the time. Everyone's talking about de-dollarisation, right? But on the ground, the reality is quite different. While the technological plumbing is shifting away from those clunky legacy banks over to the blockchain, the actual currency flowing through those shiny new digital pipes, it's still overwhelmingly the US dollar. Most stablecoins are backed by US cash equivalents like treasury bills. So the dollar's dominance isn't disappearing, it's just adapting to the new infrastructure.
Which leads us to Section 3, rewiring the financial infrastructure, or how we're disintermediating the middlemen.
Decentralized finance, or DeFi, is literally ripping out those middlemen. As highlighted in the University of Chicago Business Law Review, the whole focus here is building a brand new internet-native financial system. Instead of walking into a bank branch to deposit cash or beg for a loan, customers are trading directly with one another using stablecoins and smart contracts on public blockchains. It completely removes the need for that traditional back-office reconciliation. It's wild.
And believe me, central banks see this existential threat coming from a mile away. That's exactly why a massive 130 countries, which by the way represents 98% of the entire global GDP, are actively exploring or actively developing their own central bank digital currencies. They're scrambling to provide cheaper, better digital money before unregulated tech firms and decentralized protocols just completely sweep in and take over the payments landscape.
Okay, Section 4, the digital wallet revolution, the future interface of finance.
So, what does this actually look like for you and me?
Well, we're rapidly heading toward a world where you might not even need a traditional bank account at all. Just picture this future financial journey. First, your salary hits your digital wallet instantly in stablecoins. Then, an AI integrated with the blockchain autonomously allocates that money, balancing your portfolio across equities, commodities, and savings. And finally, that same AI pays your bills instantly, 24/7, using seamless machine-to-machine transactions. It's like having a hyper-efficient, fully automated financial assistant right in your pocket.
But before we get totally swept away by the utopian vision, we really need to look at Section 5, risks, regulation, and reality. We've got to ground the hype.
This quote from Lynn Alden is a really stark reminder of the massive crypto crashes we saw back in 2022. Look, because Bitcoin is a bearer asset that can be withdrawn and settled globally within an hour, 365 days a year, trying to apply legacy fractional reserve banking practices to it, that is a recipe for absolute disaster. The lenders who tried to fund highly liquid Bitcoin loans with demand deposits blew up entirely. This new infrastructure demands a totally new, duration-matched approach to risk management.
On top of that, despite all the promise as digital gold, the academic data paints a much more cautious picture. Studies analyzing Bitcoin's hedging properties show pretty clearly that its extreme volatility makes it behave way more like a speculative asset than a reliable, safe haven hedge during economic panics. Right now, it definitely doesn't give you that low volatility safety you'd get from traditional bonds or physical gold when the markets get turbulent.
So, wrapping this all up, what are the practical takeaways here for entrepreneurs, developers, and investors? 1, you absolutely have to understand that crypto is a massive infrastructure shift, not just a speculative token. 2, expect this high volatility to stick around. 3, digital wallets are seriously gearing up to rival traditional bank accounts. 4, clear regulation is what will ultimately dictate institutional adoption. And 5, doing your own research, or DYOR, is literally more critical now than it has ever been.
The very plumbing of global money is being ripped out and replaced by faster, completely borderless technology. So the ultimate question isn't really whether traditional banks are going to survive. The real question is, when your entire financial life can be managed autonomously by an AI in your pocket, what will you even need a bank for? Thanks for joining this explainer. Keep doing your research, and we'll see you next time.